Welcome back to the Deep Dive. We spend a lot of time on this show looking at big, abstract concepts. We talk about philosophy, we talk about history, we talk about the future of AI. But today, I want to ground us in something so immediate, so pervasive, and yet so invisible that we barely acknowledge it exists. I want you to imagine you were sitting on your couch, you're scrolling through a website, you see a pair of sneakers, you click buy.
It's the modern magic trick.
Exactly. It feels like magic. It takes, what, a millisecond? The screen says confirmed, and you go back to watching TV. But behind that single click, behind that millisecond of user interface, is a massive, industrial, terrifyingly complex machine. We are talking about the engine that runs the global economy. We are talking about SAP Sales and Distribution, or SAP SD.
It is the operating system of commerce. I mean, if you buy a car, a laptop, a pallet of bricks, or a shipping container of grain, the odds are overwhelmingly high that an SAP SD system processed that transaction.
And here is the twist for today's deep dive. We aren't just looking at the introduction to SAP textbook. We aren't going to talk about how to create a customer. We are looking at a specific guide designed for the senior consultant.
The firefighter.
Right? The person they call when the machine catches fire. This isn't about the happy path. I love that term, by the way. The happy path is when everything works.
The happy path is a myth. I mean, in the world of enterprise logistics, the happy path is what you show in the PowerPoint presentation. The reality is the exception. The reality is the truck stuck at the gate, the invoice that vanished into the ether, the pricing error that is bleeding $1 million a week.
That is our mission today. We are going to turn you, the listener, into an SAP detective. We are going to skip the definitions and dive straight into the nightmares. We're going to look at the order-to-cash life cycle, but purely through the lens of what goes wrong. So buckle up, because we are about to get into the plumbing of the global supply chain.
Let's do it.
Okay, so we have to start with the landscape. The source material outlines the standard flow order to cash, or O2C. For those who don't speak the language, give us the 10-second version of what happens when I buy those sneakers.
The 10-second version, okay. Step 1, inquiry or quotation. Step 2, sales order, that's your transaction VA01. Step 3, the system checks if the sneakers are actually in the warehouse. Step 4, delivery creation. Then you have picking, packing, and then step 6 is post-goods issue. That's the moment the sneakers physically leave the building. And finally, billing, and then accounting.
Simple, linear.
On paper, yes. But for the senior consultant, that linearity is a trap. The source material jumps immediately into a scenario that just breaks this flow completely. It's called the Intercompany Stock Transport Order, or STO.
Okay, set the scene. So this isn't me buying sneakers anymore. This is a mega corporation moving its own stuff around.
Exactly. Imagine a massive conglomerate. They have Plant A in Germany and Plant B in France. Plant A makes the engine parts. Plant B assembles the car. So Plant A ships a truckload of parts to Plant B.
Okay, so it's an internal transfer. Seems simple enough.
Physically, yes. But financially, these are two different legal entities. Plant A needs to sell the parts to Plant B. So the truck arrives in France. The guys at the dock scan the boxes. They do the goods receipt. The inventory is updated. The parts are there.
So far, so good. No problems yet.
Right. But now the finance team in Germany tries to generate the intercompany invoice. They need to get paid by the French branch. They run the billing transaction, and nothing happens. The system just refuses to generate the bill.
Is it a glitch? Is the server down? I mean, what's the first thing you check?
A junior consultant will tell you it's a bug. They'll start debugging the code, looking for some kind of error. But the senior consultant knows this is almost always a master data trap. In the specific case from our source material, the culprit was a tiny, innocent-looking flag called the Proof of Delivery, or POD.
Proof of delivery. That sounds like something you sign when FedEx drops off a package.
That is exactly what it is, and it's a legal requirement in many cases to prove the customer actually received the goods before you bill them. But here is the nightmare. Someone, likely weeks or months ago, went into the customer master data for Plant B, the receiving plant, and they checked the box for POD relevance.
What does checking that box actually do to the system logic? What's the consequence?
It installs a hard gate, a complete stop. It tells the billing engine, stop, do not create an invoice until we receive a specific electronic confirmation transaction via POD that verifies the quantity received.
But this is an internal transfer. Nobody is walking around with a scanner sending a VLPOD confirmation back to the other plant. That's not part of the process.
Precisely. The process doesn't exist for this flow, so the system is just waiting. Is waiting for a signal that will never come. The billing is completely deadlocked. You could have millions of euros in inventory that has been moved but cannot be invoiced. The books won't balance.
So how do you fix it? You just uncheck the box?
Yeah, if only it were that easy. By the time you find this, you have a backlog of dozens, maybe hundreds of stuck deliveries. So the senior consultant has to do two things. First, the detective work. You have to identify all the stuck deliveries and then manually force the POD confirmation for each one just to clear the jam. Second, and this is the crucial part, they have to go into the configuration for that specific sales area and correct the master data. You have to tell the system, look, for this specific relationship between plant A and plant B, we do not need a signature.
It's just amazing how a single checkbox can paralyze the cash flow of a multinational company.
It's the butterfly effect, but with configuration data. A tiny change has massive downstream consequences.
This brings us to another concept that the handbook highlights as a critical failure point: copy controls. I was reading this section, and I pictured, like, a Border Patrol agent.
That is the perfect analogy. Think of copy controls transactions like VTAA, VTLA, VTFL as the border patrol between the different states of the document flow. Data doesn't just flow from an order to a delivery because you want it to. It has to have a passport. It has to be explicitly allowed through the gate.
And if it doesn't have the passport,
It gets left behind. The most common error mentioned in the text is this. Item category TAN is not defined for copy control.
we're going to hear TAN a lot today. Remind me, what is TAN?
In SAP speak, TAN is the vanilla flavor. It's the standard item category for a physical good that you sell and ship from your stock. Now, here is the scenario. The marketing department comes to you and says, we need a special order type for our VIP customers. We want to call it the Gold Rush order.
Okay, so you build a new order type. Let's call it ZGOLD.
Right. You build ZGOLD, you set up all the pricing, you test the order creation. It works beautifully. Then you go live. The first VIP customer places an order. The warehouse gets the notification. They try to create the delivery, and the order is empty. The items are gone.
Because you forgot the Border Patrol.
Exactly. You created the new state, your ZGoldie order type, but you didn't update the treaty at the border. You didn't go into the copy control settings and explicitly say, when moving from a ZGoldie order to a delivery document, I want you to allow item category TAN to pass through. The system blocked the items because it wasn't explicitly told to let them in.
It's a system of permission, not assumption.
SAP assumes absolutely nothing. If you don't tell it to do something, it won't.
This gets even spookier with the lost data mystery.
Yeah.
The source material talks about custom fields, Z fields, that just vanish.
Oh, this is a classic. Every company has custom needs. Maybe they need a field on the sales order for quality inspector ID or special wrapping instructions. You hire a developer, they add the field to the order screen, you type in the data, you hit save.
It's in the database. You can see it there.
It is, but then you create the delivery note to send to the warehouse, and that field is blank. The special wrapping instructions are gone. The warehouse guy wraps it in standard paper, the customer complains, and everyone blames the software.
Where did the data go? Did the system just delete it?
It didn't cross the bridge. This is where we have to talk about something called the transfer routine, which is part of VOFM. When SAP copies data from an order to a delivery, it runs a specific routine, a little block of code that maps the fields. The standard routine, let's call it routine 001, is hard-coded by SAP. It says copy name, copy address, copy material.
It doesn't know about special wrapping instructions.
Exactly. It doesn't know your custom field exists. So the senior consultant has to write a Z routine, let's say routine 901. In that code, you have to explicitly write the logic. Go to table VBAK, find the wrapping instructions, and move them to table LIKP in the delivery. You have to build the bridge yourself.
So if you don't build the bridge, the baggage doesn't make it to the destination.
And the bus leaves without it. Every single time.
I want to move to section 2, because this is where the logic starts to feel almost philosophical. The text makes a distinction between the business brain and the logistics brain of an item.
This is the fundamental duality of SAP SD. You have to understand this, or you will never troubleshoot a problem effectively. Every line item in an order, let's say that pair of sneakers, has two identities, two brains working at the same time.
Okay, what's the first identity, the first brain?
The first is the item category. This is the business brain. It's determined by a combination of things, mainly the order type plus the item category group from the material master data. The item category decides the commercial rules. Is this item free? Do we bill for it? Is it a product or is it a service?
So the item category talks to the finance department. It's about the money.
Correct. But then you have the schedule line. This is the logistics brain. This is determined by the item category plus another field, the MRP type. The schedule line decides the physical reality. Does this trigger a requirement in the warehouse? What movement type, like the famous 601, do we use to get it out the door?
So business brain says send an invoice, and logistics brain says load the truck.
Exactly. And the source material highlights a determination trap where these two brains get out of sync because of a master data change. This is a story that keeps consultants up at night.
Walk us through the disaster. How does it happen?
Okay. Monday morning. You create a sales order for a widget. The system looks at the master data for that widget, sees the group is norm for a normal product, and assigns item category TAN, standard stock. You save the order. It's a valid legal contract.
Done. Locked in.
Tuesday afternoon. A data steward, someone in the back office, is cleaning up the material master. And they look at that widget and think, you know what, this isn't really a product, it's more of a service pack. So they change the item category group in the material master from norm to DIN, which stands for service in German.
Okay, but my order from Monday is already saved. It should be saved, right?
You'd think so. But Wednesday morning, you open that order again in change mode transaction VA02, maybe just to update a shipping date or a note. As soon as you hit enter, SAP says, hold on, let me revalidate the facts. It looks at the material master again. It sees DIN.
And it changes the past.
It redetermines the item category. In real time, it flips your TAN, the physical product, to Tech X, a non-stock service item. And here's the catastrophe. Service items do not have schedule lines in the same way products do, so the system deletes the schedule lines from your order.
Which means the warehouse requirement is deleted.
Poof! Gone. Vanished. You have a confirmed sales order that the customer thinks is coming, but the warehouse has absolutely no record that they need to ship anything. You broke the logistics by changing a simple definition in the background.
That is the definition of a ghost demand.
It is, and happens constantly. The sales team is screaming, we sold it, where is it? The warehouse team is screaming, we don't see it in our system.
And the culprit is usually the transfer of requirements.
Yeah.
That's the little flag that controls this.
That's the configuration side of the ghost. Inside the schedule line setup transaction VOV6, there is a checkbox called Transfer of Requirements, or TOR. If that box is unchecked for a particular schedule line category, sales can promise the moon. They can enter an order for 1 million units. But MRP, the system that tells the warehouse what to buy and move, will never, ever see it.
It's a communication breakdown hard-coded into the system. It's designed to fail silently.
There's another checkbox right next to it called RIC assembly. If you miss that one, the integration between the sales order and the production order breaks. So you sell the car, but the factory never gets the order to build it.
It seems like so much of this job is just ensuring that the left hand knows what the right hand is doing. It's all about connecting the dots.
That is the definition of ERP, Enterprise Resource Planning. It's all about the handshakes between different departments.
Let's talk about when the handshake happens, but the physical reality refuses to cooperate. Section 3. Logistics lockdown. We have the order. It's clean. We are ready to ship. We go to transaction VL01N to create the delivery, and the system just says no.
No is polite. Usually it gives you a cryptic log error that looks like hieroglyphics. The handbook breaks down the 3 big reasons why a confirmed order fails to become a delivery.
The first one is shipping point determination. I read about this. It relies on 3 factors: shipping condition, loading group, and plant.
Right. And the one that usually breaks, the one people forget about, is the loading group.
What is a loading group, practically speaking?
It represents the physical equipment you need to put the goods on the vehicle. Do you need a forklift? Do you need a crane? Do you need a special pipe for a liquid? Do you just need a hand truck?
Why does the system need to know that just to create the document? It's not physically loading anything yet.
Because the shipping point is a physical location in the plant. The crane loading point might be on the north side of the building, Dock A. The forklift dock is on the south side, Dock B. If the material master doesn't have the loading group defined, the system doesn't know where to tell the truck to go. It can't determine the correct physical shipping point.
It's like ordering an Uber, but not setting a pickup pin. The driver just drives in circles and then cancels the ride.
Exactly. The Uber never comes. The delivery never gets created.
Then there is route determination. This felt like a geography problem.
It's geography plus physics. The system calculates the route based on where you are leaving from, where you are going, and crucially, the transportation group in the material master.
The transportation group defines the how, not just the where.
Right. Is the material on pallets? Is it bulk liquid? Is it frozen? You cannot send a bulk liquid tanker down a route that is restricted to small vans. You cannot send frozen goods on a route that takes 3 weeks without a refrigerated truck. If the transportation group is missing, the system can't solve the logistical puzzle. It can't match the vehicle to the road.
So no route, no delivery.
No route, no delivery. And another simple one is the date logic. The selection date you enter in the delivery screen is before the schedule line date in the order. The system won't travel back in time.
Now let's say we get past all that. The delivery is created, the truck is at the dock, the driver's drinking his coffee, the warehouse guy clicks Post Goods Issue, or PGI. This is the final button, and that gets blocked.
PGI blocks are the most stressful because the physical world is literally waiting, the engine is idling. One of the most common causes is the stock deficit.
But wait, we checked availability back when we took the order. The system confirmed it. It said we had 10 units.
We checked it then. But between the time the delivery was created and the time the warehouse worker clicked ship, life happened. Maybe another, more urgent order came in and stole the stock. Maybe the warehouse did a cycle count and realized, oops, we actually only have 9. The physical reality changed.
The dreaded deficit of SL unrestricted use.
That's the error. It means you promised 10. I can only find 9. I cannot ship what I do not have. The system will always protect the integrity of the inventory over the customer promise in that moment.
And the other one mentioned was the status block. This one said it particularly cruel.
The status block is the silent killer. Imagine a data steward decides a product is obsolete. They go into the material master and set the plant-specific material status to 04 discontinued. They do this at 10:00 a.m.
Okay, so it's officially discontinued.
At 10:05 a.m., a warehouse worker tries to ship an order for that product that was created 2 weeks ago. It's a valid order. The stock is physically there on the shelf, but when they click PGI, the system checks the material status in real time.
It sees the discontinued flag.
It sees the flag. It looks at the configuration for status 04, which has been set to error on goods issue, and it stops the shipment dead in its tracks. A truck is blocked because of a database update made 5 minutes ago about someone in a different department.
That really drives home the point that SAP is a living organism. It's not a filing cabinet where data just sits. It's reacting to the present moment.
A very strict, very literal organism. It doesn't care about the angry truck driver. It cares about the rule.
Let's move to the part where the stakes get even higher. Section 4, the money machinery. We're talking about pricing and billing. If logistics breaks, the customer is annoyed. If pricing breaks, the company loses money or gets sued or fails an audit.
Pricing is probably the most complex engine inside SAP SD. It uses something called the condition technique. It's a massive decision tree. When a senior consultant sees a wrong price, they don't guess. They go straight to the analysis button in the conditions tab of the order or invoice.
What did the analysis show you?
It's a log of the system's brain. It shows every single attempt the system made to find a price. The most common error you see is access not made.
Which means what in plain English?
It means the system looked for price tag, say, for this specific customer and this specific material, and came up empty. The key combination didn't match any records. There was no price maintained for that scenario.
I want to dig into the new pricing danger mentioned in the source material. This sounded like a trap waiting to happen. You have a price in the order, the customer signed the quote, but when you bill them, the price suddenly changes.
This happens all the time because of the copy control settings again. Specifically, a field called the pricing type. Let's play out a scenario. You are a customer. I give you a special 10% discount valid until January 31st. You place the order on January 30th. You secured the deal.
Great, I expect my discount. I have it in writing on the order confirmation.
But we don't ship the goods until February 2nd. The system creates the invoice on February 2nd. Now, if the copy control pricing type is set to B, which stands for carry out new pricing, the system says, okay, new document, new date, let's recalculate the price for February 2nd.
And my discount expired on the 31st.
Exactly. So the system just drops the discount.
Correct.
You get an invoice that is 10% higher than the order confirmation. You are furious. You call customer service. It's a complete mess.
How do you present that? It seems like a fundamental flaw.
You use pricing type G. That tells the system, copy pricing elements unchanged and redetermine taxes. It freezes the price elements from the sales order. It honors the deal you made on the day you made it.
It seems like G should be the default. Why would you ever want B?
Think about commodities. If you are selling gold or oil, the price fluctuates hourly. You want the price to update to the market rate on the day of shipment. It's not a bug, it's a business decision. But if you make the wrong decision in the configuration, you destroy customer trust.
Let's get technical with the code behind the pricing. The VOFM logic appears here too. The handbook lists 3 columns in the pricing procedure: requirement, condition-based value, and condition value. I want to break these down because they seem like the levers you pull to customize the math.
They are the toolkit. They're how you make the standard system do non-standard things. First, the requirement. Think of this as a gatekeeper. It's a small piece of code that returns a simple true or false. For example, you might have a special employee discount. You write a requirement that says, check the customer master. Is the personnel number field populated? If yes, return true. Open the gate. If no, return false. Close the gate.
So if I'm not an employee, the system just skips that line entirely. It doesn't even try to calculate the discount.
Exactly. It hides the discount from anyone who doesn't qualify. Next is the condition-based value. This manipulates the starting point of the calculation, the basis.
Give me an example.
Okay. Standard tax is calculated on the net value of the goods. $100 of shoes, 10% tax is $10 tax. But what if your local law says you have to pay tax on the freight charges too? You use a base value routine to say, don't just take the $100, take the $100 for the goods plus the $10 for the freight. Make the basis for the tax calculation $110.
You are redefining what value means for that specific calculation.
Correct. You're changing the base. And finally, the condition value. This manipulates the final result of the calculation. A classic example here is a statistical condition. Let's say you want to track the cost of the goods sold, your VPRS condition, on the invoice for margin analysis, but you don't want the customer to see it or pay it.
Right. I don't want my internal cost on the customer's bill.
You use a condition value routine that says, calculate the value and store it in the database, but force the active value in the pricing total to 0. It keeps the number for the report, but ignores it for the checkbook.
Fascinating. It's like a completely programmable calculator running in the background. Now, speaking of calculators, we have to talk about the penny war, rounding differences.
Ah, the penny war, the bane of every accountant's existence. The math problem is surprisingly simple. Suppose you sell 100 units at 0.3333 each.
Okay, 100 times 0.333 is 33.3. So that should be $33.30.
Correct. But imagine the system calculates tax line by line, and it has to round each line to 2 decimals before summing them up. Or maybe you have 3 separate lines of 33 units. You might end up with a total invoice of $33.31 or $33.29.
A 1 cent difference, who cares?
Accounting cares. In the world of SAP, a 1 cent difference is a fatal error. The accounting document will not balance. Debits must equal credits. If they are off by 0.01, the system refuses to post.
So how does the handbook say, we fixed this? How do you win the penny war?
2 ways. First, there's a setting called group conditions. This tells the pricing engine, don't round yet. Sum up the basis of all the relevant items first, calculate the tax or discount on the total, and then distribute it back. It minimizes the rounding noise.
And if there's still a penny left over after all that?
SAP uses a specific condition type called DIF. It's basically a bucket for rounding errors. The system automatically identifies the rounding remainder, that 0.01, and dumps it into the DIF condition so the final total balances to the penny.
It is wild to think that a billion-dollar enterprise system needs a specific bucket just for stray penny.
Accounting has to be exact to the cent. There's absolutely no close enough.
What about when you realize the price was wrong after you've already billed the customer? The retroactive nightmare.
This is a scenario that happens in almost every industry with long-term contracts. You negotiate a price increase with a customer effective January 1st. But the contract sits on a lawyer's desk. Then it sits on a data entry clerk's desk. The system isn't actually updated with the new price until January 15th.
But business didn't stop. We kept shipping and invoicing for 2 weeks at the old lower price.
Exactly. You have 2 weeks of invoices that are technically wrong. You undercharge the customer.
So what do? Do you cancel all of them and reissue them one by one?
You could, but that is incredibly messy. It looks unprofessional, and it messes up all your invoice numbers. The senior consultant uses transaction VFRB retro billing. It is an incredibly powerful tool. You give it the date range and the customer. It scans all the invoices in that period. It compares the price you charged on the invoice versus the price that is currently in the master data.
It finds the delta difference.
It calculates the difference for every line item and automatically creates a debit memo request for the total amount. Hey, we undercharged you by $500 total. Here's the bill for the difference. It cleans up the mess without destroying the historical record.
That sounds like a lifesaver. But the handbook warns about a mass update disaster.
Oh, yes, this is the dark side of pricing. If you use a mass upload tool to update prices and you accidentally upload the wrong price for 10,000 material,
Oh, no.
there is no undo button. There is no CTRL-Z in SCP pricing. You have just corrupted your master data.
But you have to fix them one by one. That could take weeks.
You have to identify the bad records and then delete them or re-upload the correct ones. But here is the real trap. Even if you fix the price in the master data today, the open sales orders, the ones created yesterday with the bad price, are still holding on to that old bad price.
They don't update automatically.
Not always, depending on your settings. You have to run a special program, a transaction called OPE1, to force the system to go back and scan all the open orders and reprice them with the new correct data. If you forget that step, you fix the database, but you still ship at the wrong price for weeks.
It sounds like open heart surgery on the database. You have to be so careful.
It requires absolute precision. One wrong move and you've repriced the entire company's order backlog incorrectly.
Let's move to Section 5, the availability illusion. We touched on this with the Ghost Command, but I want to talk about ATP, available to promise. The handbook calls the scope of check configuration transaction OVZ9 the most dangerous setting in the system. Why is it so dangerous?
Because the scope of check defines reality for the availability check. It is a matrix of checkboxes that tells the system what counts as stock and what counts as demand. And the most dangerous flag inside that setting is the one called check without RLT.
RLT stands for replenishment lead time. What happens if you get that setting wrong?
If check without RLT is unchecked, the system turns into a dangerous optimist. It assumes you can manufacture or procure anything within the standard lead time. Let's say your material master says in-house production time, 5 days.
Okay, 5 days to make it.
You have zero stock on the shelf, zero. A customer places an order for 1,000 units to be delivered in 6 days.
Logic says we have zero stock, and maybe the factory's fully booked, so we can't possibly promise that.
But the system looks at the math. It says, hey, the customer wants it in 6 days. The lead time is 5 days. 6 is longer than 5. If we start now, we can make it. So it confirms the order. It promises the stock.
It doesn't check if the machine is broken, or if we have the raw materials to even start.
The standard ATP check is not that smart. It doesn't know about factory capacity unless you are using advanced planning modules like PPDS. It's a simple time check. If you aren't careful with that check without RLT setting, you end up promising stock you cannot possibly deliver. You are essentially lying to your customer automatically.
That is terrifying. And what about stock and transfer? What's the debate there?
That's another one of those critical decisions in the scope of check. Do you count stock that is currently on a truck moving between Plant A and Plant B as available?
Well, it's our stock, right? We own it.
It is, but it's not usable yet. If you check the box to include it, you increase your available quantity. You can promise that stock to a customer. But if that truck crashes or gets delayed at customs or gets lost in a snowstorm, you have a problem. You are betting on a future event that hasn't happened yet.
We are coming into the home stretch here. Section 6. Accounting and integration. This is the cash part of order to cash. We mentioned earlier that the invoice can fail to generate an accounting document. Why does the billing handshake fail?
This is where sales meets finance, and it's a very common point of friction. You can create a billing document transaction VF01 and save it. It generates a number. It looks real. But if you check the document flow, the accounting status is error. The most common reason, by far, is the posting period.
Meaning the month is closed.
Exactly. You are trying to post a bill on February 5th, but the invoice date is January 31st. If the finance team has already closed the books for January using transaction MMPV, the door is locked. The system blocks the entry because you cannot post to a closed financial period.
And what about account determination? That sounds critical.
Transaction VKOA, this is the map. It's a big table that tells the system. For this combination of customer group, domestic, and this material group, electronics, post the revenue to GL account 400,000.
It's a lookup table to find the right bucket for the money.
It is. But if you launch a new product group and you forget to update VKOA, the system tries to post the revenue from that product, has nowhere to put the money, and it errors out. The invoice is created, but the money is stuck in limbo.
I want to clarify down payments. It sounds simple. The customer pays some money up front. But the handbook makes it sound like a complex Rube Goldberg machine.
It is not just a checkbox, it's a multi-step integration that has to be perfect. First, the sales order needs a billing plan to define the dates and amounts. Second, you generate a down payment request. That's billing type FAZ. This isn't a real invoice. It hits the books as a special kind of document called a noted item.
A noted item, what's that?
It's basically a reminder in the financial system. It doesn't affect the balance sheet yet. It just says, we are expecting money from this customer. Third, the customer pays. Finance posts the cash, usually with the special GL indicator F. Now the money is real and on the books. Fourth, and this is where it breaks, when you do the final invoice, the F tier for the actual goods, the system has to recognize that down payment has been made and clear it.
It has to subtract the down payment from the final total.
Right. If that configuration chain is broken, the system ignores the down payment and bills the customer for the full amount again.
So they pay the down payment, and then they get a bill for the full price on top of that.
Correct. Which is a fantastic way to lose a customer permanently.
One last distinction that seems important. Cancellation versus a credit memo. They sound the same. I'm giving money back.
They are totally different in the eyes of an accountant and an auditor. A cancellation using transaction S1 or VF11 is for correcting a mistake. You sent an invoice with the wrong tax code. You cancel it. The system reverses the original journal entry exactly. The net effect on the books is zero. It's like it never happened.
Okay, so it's an oops, disregard that last one.
A credit memo coming from a request type like G2 is a valid business transaction. You sold the goods, the transaction happened, but maybe they were damaged, or the customer returned them for a valid reason. You are issuing a new document to give them credit.
So it creates a new entry. It doesn't just erase the old one.
It creates a new open item on the credit side of their account. It offsets the invoice, but it doesn't erase history. It adds to it.
And finally, the pro forma invoice. This sounds like a trap.
The pro forma is the great deceiver. You use it for customs declarations or to show a customer what an invoice will look like. It looks like an invoice. It prints like an invoice. But it creates no accounting document whatsoever. And crucially, it does not update the billing status of the order to completed.
So you can send a pro forma, and the system still thinks the order is open and ready to be billed.
You can create 100 pro formas for one order. The order stays open. If you aren't careful, you might accidentally send a real invoice later, double billing the customer. Or you might just wonder why the order never closes on your reports. It's because the pro forma doesn't count.
We have covered a staggering amount of ground today. From stuck trucks at the loading dock to penny rounding errors in the general ledger.
It really highlights the job of the senior consultant. It's not about knowing the transaction codes. Anyone can Google how to create a sales order. The value is understanding the integration. It's knowing how a master data change in the warehouse triggers a billing block in finance. It's seeing the invisible threads that connect all these silos.
It makes you realize how fragile these systems can be. The handbook mentions things we didn't even have time to cover, like incomplete logs for gross weight, causing freight calculation failures.
It raises a provocative thought to end on. We live in a world of automated supply chains, just-in-time delivery, AI-driven logistics. But consider this. A single missing weight field in a material master record can physically stop a shipment at a national border.
Why? How can one field have that much power?
Because the intrastat compliance reporting, which is mandatory for trade within the EU, for example, requires the weight of the goods. If the weight is 0, the report fails. If the report fails, the customs paperwork doesn't print. The computer says error, so the truck doesn't move.
The entire supply chain halts because of one empty field.
Exactly. The digital world is incredibly powerful, but it is also incredibly fragile. It relies on perfect, complete data. So for the listeners out there, look at your own systems. Are you checking stock and transfer? Are your copy controls preserving your pricing? Or are you one checkbox away from a halted supply chain?
A sobering thought for anyone clicking buy today. That's all for this deep dive into the machinery of global commerce. We'll see you next time.